So with that, I will go ahead and bring up Josh and Debbie. Come on up. I will tell you that Josh is an engineer and Debbie's an engineer too. It took us a while to get through these slides to kind of get them so that I would understand them, let alone you would understand them. So we'll go from there.
He really had to rein that in. He was pretty disappointed in us. So yes, we're nerds. We're both engineers. We both have our lead certs. We both spent more than 15 years in oil and gas and technical sales. She's got me beat though, because she also comes with 6 years of property management experience over 10 different apartment complexes. And that's more than 1,500 doors that she helped do the property management for. She's also been a Lifestyles member since 2008. I've only been in since 2014, so I kind of pale in comparison. I do, however, have credentials through the National Apartment Association for Certified Apartment Manager and Independent Rental Owner Professional. That's a mouthful.
That's a lot of work. That's a lot of words. Wait, I don't think you managed to do that.
Yeah.
There.
No. Where are we? Did it double jump? Oh, wait. Okay.
Okay, all
There
right.
we go.
So basically, we both came to Lifestyles on much different paths. As he mentioned, I came into Lifestyles a long time ago, 2008, and the first exposure that I had to Lifestyles jumped straight into multifamily. And within just a very short time, multifamily syndication and property management became the family business. And so that allowed, a lot of things within my life. There was a lot of success in the family business and through acquiring multifamily properties. And in 2014, I was able to retire from my corporate job. So I was able to walk away from my six-figure income in oil and gas and really kind of dive into the family business. And my role was to kind of operate the rehabs, to manage contractors, to be responsible for a lot of the investor relations and that type thing. And then the financial security and financial freedom from investing in those assets, and I think there's probably about 30 or so multifamily investments that we have currently, allowed me over the last 10 years to not have to go back to a corporate job and to go back to a 9-to-5 job. But I did find that I needed a little bit more purpose. I needed something else to do. I needed things to keep me busy. And so a few years ago, I kind of dove back into something I always wanted to do and became a part-time teacher. I teach algebra at my kids' private school, so that allowed me to be plugged into their life and gave me that purpose, but it does not pay the bills, so.
And as I had mentioned, Debbie was the one that introduced me to Lifestyles. As far back as college, I knew that I wanted to do something with real estate. For my 21st birthday, I asked my parents to get me the compendium of the Rich Dad, Poor Dad series. And as soon as I came out of college, I went into purchasing a house, purchased a foreclosure, did 90% of the rehab myself, lived in the construction site while I did it, and then flipped it. And was pretty, I made gains off of it, but I was pretty disheartened by the amount of gains I got off of it for the amount of effort I put into it. And then through some other life changes, I ended up not pursuing real estate further. A couple of years later, Debbie comes into my life professionally and starts introducing the fact that she's been part of the Lifestyles Network. Even at that point, I was still skeptical. I joined in 2014, but did the cardinal sin of essentially doing nothing with the education. Part of that was ego, part of it was stubbornness. I felt like I needed to go out and create my own system, do something else. I ended up trading in cryptocurrency, which ended up building my net worth, but it didn't pay me a dime in distributions. And when we started dating, I was in the process of trying to get a startup company off the ground, and I was starting to realize exactly how much cash flow was being a constraint in my everyday life as I'm trying to do that. And that's when she actually filled in all the gaps that I had about what the Lifestyles model was about. And then it was off to the races from there. And we actually started investing in real estate before we got married together.
Yeah, Yeah, so we've actually built a portfolio of single-family houses. We've had as many as 11. We're down to 7 now. We can give you a good deal on one if you really want one. We can talk to us later. But we also are passive investors in several multifamily apartment complexes, totaling about 5,000 units. And now, through Lifestyles, through the education and the mentorship that we've had over the years, we are actively managing 2 apartment complexes in Knoxville, Tennessee. And here we are. Here is Castle Terrace Apartments. It's located in North Knoxville. This property is very strategically located, or very nicely located, off of 2 major interstates. And just so that you know, it's about 10 minutes from downtown Knoxville, where University of Tennessee is located. Also, lots of businesses in and around the Tennessee area. I'm actually from Tennessee. I grew up just outside of Knoxville in a tiny little town that nobody's ever heard of. But so this was kind of home. This was going back into something that I was very familiar with when we started talking about the Knoxville area. But these properties, it is 9 buildings that is located on 4.7 acres. So even though it's fairly close to downtown, it's a nice community feel in a quiet neighborhood. And a small property happens to be located next to a community park, and our residents get some advantages of that as well. So this property is 35 units, and it was built somewhere between beginning the first building in 1978 all the way up through 1993. And we purchased that with a group of investors. And if you are an investor in Castle Terrace Apartments, do you guys stand? Stand. Don't just wave at me. Look at you guys. Thank you for coming out. I appreciate you guys coming all the way out here on no power in the remnants of our hurricane to come out to listen to us today. And I appreciate you guys investing your money and your faith into to our venture. So I appreciate that, because this is definitely our baby project. So, but September of last year, the property was purchased for just over $4 million. And all of the investors together came up with $2.7 million. And the rest we financed. We took over a loan from the previous seller. We assumed the loan of $2.1 million. And it was at a fixed interest rate, 4.29%, which, if you remember September of last year, interest rates were going crazy. Absolutely crazy. So we were super fortunate to be able to lock into a low fixed interest loan that still had 7 years remaining on the life of the loan. And out of that $2.7 million cash that was raised, we allocated about $560,000 to do rehab. And the rehab would be to upgrade the curb appeal of the property, to fix things that are broken, like ACs that were really, really old, reduce the parking lot. But also, there's one thing we'll talk about in more detail later. Take a leasing office from a leasing office that you don't need for a 35-unit property to a rentable space. So.
Okay, hold on one sec. So a lot of things they talked about here, Chris is going to go over this weekend. And so if you don't understand this completely, don't worry about it. But what I want you to understand is, I'm not. Can you hear me? Yeah. We're good? Okay. It's green. It says green. Green means go. All right, so they bought it for $4 million, a little over $4 million. Cash out of pocket means everything that them and their investors raised, okay? So in that $2.7 million included the $560,000 worth of capital they were going to do. It included their closing costs. It included their lawyer fees. It included all that stuff. They raised $2.7 million. He'll go over this weekend, but I will tell you, financing makes or breaks a deal. Think about what was going on last year and the year before. They assumed a 7-year note interest only at 4.29%. Who would like that today? Well, right? Exactly.
It wasn't interest
Well,
only.
correction, it wasn't interest only, but it.
Oh, it's not interest only?
No.
Damn, you killed my thing. All right.
I know, I'm
All
sorry.
right. Still, that's a darn good rate. Even paying down principal Was it interest only at the start?
No.
No? Okay, well, no worries. One of the ways you build wealth, right? You're paying down the principal the entire way, right? So kudos. All right, awesome.
Okay, since I do see quite a few newcomers out there, one of the things I wanted to touch on here is that the value of a multifamily property is not the same as how you get to a value of a single-family property, like in the proposals that you just saw. So the value of a multifamily property is directly related to the operational net operating income. So the other thing to note is that Debbie had mentioned that we purchased this in September of 2023, which means that we've got 8 months of actual runtime data. And for NOI, you take a 12-month term for your calculations for value. So what we've done here is we've taken our 8-month actuals and we've annualized them. So we take our operational income of $498,000 minus our $175,000 in expenses to arrive at a net operating income of $323,000, and I'll get later into how that creates the value that we come into. That means that we're getting a monthly cash flow of $16,000, which when annualized is a cash-on-cash return of 7% of the amount of the investment that everybody put in, that $2.7 million that we talked about. So far, operationally, we've been very blessed, and we were able to do our first distribution within 6 months of operation. We've distributed $33,000 to the passive investors, and we're actually on track right now to do the next $33,000 but before the end of the month. So then,
Which we did not say, you know, at the beginning, you always, you project what you think that you're going to do your first year, your second year, your third year. And we said that we probably would not be distributing at all for the first year because we didn't know what we would see. We didn't know what kind of things that we would come across. So we're pretty excited that within 6 months of operation that we were able to do our first distribution. So.
yep.
I want to point out one thing for the people that are from Texas. You might think this is a mistake. The annualized income is roughly $500,000. The expenses are $175,000. And the NOI is like $323. That expense ratio seems very, very low. If you're in Texas, Houston, Dallas, those expenses is probably like more like $300, $350, something like that, which would make your NOI a lot less. So for the same property here in Texas versus in Tennessee, the valuations are based on your net operating income. Chris will go over that this weekend. Multifamily valuations are based on your net operating income. So don't care what the revenue is, don't care what the expenses is, the net operating income is how you value the property. So the same property, the same annual revenue, same year classification as build is worth completely different in Tennessee as it might be here in Texas. It doesn't matter where in the nation you are, the valuation is based on your NOI. Everybody get that? Awesome. Now, I noticed one thing at the bottom. It says current valuation of 5.38. Go back one slide. What did you purchase this for? Purchase it for $4 million, and go to the next slide. It's already worth 5.3. Why is that? Because of the net operating income. Very good. All right, awesome.
Okay, so we took a property that was actually, we thought it looked pretty good as is, but we took a tired property. We wanted to give it a facelift. We wanted to put a new look onto this property. And really there's 9 buildings that all look very similar to what you see here. The flat roofs were in pretty good shape. We didn't have to do very much with that. But what we did do was take the asphalt shingles off of the roof mansards, and we replaced that with vinyl siding. We also updated the color scheme of the property, and it just looks like a brand new place. And so we've got a lot of good feedback from residents about the upgrade that we did, as well as we've resurfaced the parking lot in the last 5 days, yep. And it looks like a brand new place.
One other thing to mention about the mansards, so they were pretty deteriorated, and when we replaced the vinyl siding on it, we also resealed them. So it's not just an aesthetic thing, it's also a functional thing, because during heavy rains and stuff, you could have leaks come through, and you're going to be chasing that with your maintenance team. We've got that taken care of because we redid the mansards on there.
The other thing that we did was we took the balconies and the patios and pressure washed all of those, resealed to preserve the life of those. We replaced any that had wood rot and fixed those up. You know, the other thing that is something that we don't see a lot in small properties is a lot of amenities. So we really have to highlight what we have. And one of the things that residents really like are our balconies and our patios. But we also have a fire pit and picnic area and pergola. So we wanted to make that pop also and make a very inviting place for our residents to hang out. Now this is probably a little bit of an exaggeration of the before picture of the property at night, but it did kind of look scary and it did kind of look like a forest because there are a lot of trees. The previous ownership, the buildings, when we took over, they had mixed match lighting all over each of the buildings, and for the most part, none of them worked. I mean, it was dark there. When we started replacing the mansards on the new buildings, we went back with all new LED lights. So not only gave a really nice lighting for the property, but it reduces our electric bill as well. And it looks, I mean, the residents really enjoy the feel of the safety and just the brightness and coming home from, coming home from work and having a lit up place. The interiors were in pretty good shape when we got the property. They had a lot of things that we could use to build off of. The kitchen cabinets were solid oak. I mean, they were in good condition. And the previous management had replaced a lot of the flooring with vinyl flooring already. But what we wanted to do is take our current rents and really elevate those to the next level. And we thought that we needed to do that by adding an upgraded look to the units as well. And so we painted the cabinets, we upgraded the countertops, we changed out the sinks and the faucets in the kitchen. We made sure that we had all matching black appliances throughout the kitchens and added brushed nickel hardware throughout. And in the bathrooms, if they already had some rough-looking shower surrounds, we either replace them to fiberglass or refinish them, whichever one we could do. And we added this accent across the top of the shower just to give it a nicer, classier look. All of the mirrors and vanities, if they were in bad condition, we replaced that as well.
Okay, so as we go into the numbers, one of the things I want to reiterate is that the year one numbers that I'm showing are annualized figures based off of our 8-month operations. Now, years 2 and 3 happen to come from the multifamily quick analysis tool that Lifestyles uses to do your underwriting for a property. It's known within Lifestyles as the MFQA. So these are the figures that we presented to our investor group as we projected out what we thought we would do for years 2 and 3. As we come into the most important one, which is the net operating income, you may notice that year 1 is greater than year 2. That's because in year 1, we were actually projecting that we'd make far less than this in net operating income. We've surpassed years 1 and 2 and are encroaching on what we thought we would do by the end of year 3 in terms of the net operating income with this property.
In 8 months. Well, annualized for 12 months.
Yeah. So when you take the net operating income and you subtract off the mortgage, you come out with what is the net cash flow. So we take the 323 minus 127, you come up with 196. That 196,000 weighed against the initial 2.7 million that the investors invested alongside of us comes out to a cash on cash return of 7%. So that's what we're doing on an annual basis and distributing most of to the investors. Now, as you go into years 2 and 3 in the cash on cash returns, you see the dip. Once again, that's because they're projected numbers. We feel very confident now, based on where we're at, that we'll be able to surpass those, and hopefully we do. So this is a little slide that I pushed for, and I got Lee to cave on. So as a way to weigh how you're doing operationally, you're looking at NOI, and in particular, you're looking at NOI against what you quoted again in your MFQA. So what we have here is an excerpt from a mid-year review that we did with our investors, where we took 6 months of actual data, where the orange line, or I guess it kind of looks red up there, was the actual data that we had from operations for our NOI against the blue line, which is the MFQA data for that time period. And as you can see, we managed to do 129,000 in that 6 months, whereas we were projecting the 95. So we overshot that target by 35%. The other thing that we were trying to weigh against is how did we do against the prior ownership as well? Because we were taking it over and we thought we could change operationally. So when we looked at what the prior ownership did in the same time period the year before, we surpassed their NOI over the same time period by 80%.
Okay, I did let Josh put this slide up here, but I'm going to tell you that if any of y'all have ever seen me, when we do road trips and we go over projections and analysis and things like that, the MFQA, or the initial budget that they did before they purchased it, that's what that estimate is, okay? You will never hit that estimate, good, bad, or indifferent, okay? Once you purchase it, you're discover things that they could do better, things that might not go according to plan, but you're never gonna hit that. And if you couldn't do better than the guy you bought it from, then I don't know why you bought it. That was another thing, so. But good job, awesome.
That's all I wanted from you. That's all I wanted. All right, so I said before that we were going to get into how you get to the value of the property. So for multifamily properties, you get to the value by taking your net operating income and dividing it by the area cap rate. I won't get into what a cap rate is. You're just going to have to trust me on it.
We'll get into that this weekend.
So the area cap rate for Knoxville right now is about 6%. So you take the $323,000 in year one that we had projected, you divide it by the 6% cap rate, you get to roughly $5.4 million property valuation. So if we were to take this property and sell it at the end of year one, you would take that $5.4 million, subtract off the debt that we currently hold on it, which is the roughly $2.1 million, and then return the initial investor capital of $2.8 million. You're going to come up with an equity capture of about $506,000. So that's just pure profit after you returned everybody's money. You also have the cash flow that happened in the 12 months of operation, which rounds out the total return to $702 in year one, and that's 25% return on investment based on the $2.7 million. So fast forward to year three, we're looking at a projected return of $1.781 million to the investor group, which is a 64% return on original investment in 3 years.
Okay. Again, I just want to make sure you guys understand these are numbers, but this, because sometimes these are numbers right here, right? And it's like, not the graphs. The graphs are beautiful. I like the graphs.
Those are nice graphs.
So the initial capital, that's what everybody invested, all right? So you invested money, you're going to get cash flow along the way, distributions, but when you sell it, we're going to give you all that capital back to you, okay? So in addition to that, you're going to make another 1.2 million, and probably in year three, I'm guessing that it's probably going to be more than that based on our current numbers that we have. But that's how much they make. In the first year, they've increased their equity by 25%. That's $700,000. This is $1.8 million. We're talking millions of dollars, hundreds of thousands, as opposed to the single family where we're talking about tens of thousands. That's the beauty of multifamily. That's the beauty of having a great lead that can take something, buy it at the right price, put the proper loan on it, pay out distributions, and when it's time to monetize, they will sell it, and they will give you all your money back, plus. Congratulations. Awesome.
You want to control this one? You trust me? Okay.
So how did we increase the NOI so much in so little time? And I guess the biggest thing that we did was we raised rents immediately. We recognized when we toured this property and did our due diligence and we did our market survey that this property was significantly less, the rents were significantly less than the market should be. So we knew we needed to overcome this gap, and that's what we did. In the first 8 months of ownership, we've had 28 of our 35 leases expire. And so we went to these that were having their lease expire, and we were aggressive. We were very aggressive and asked for $250, $300 increase, and we hadn't done a thing to their property, anything to the inside of their property at all. And 20 of those residents chose to stay at that property because they enjoyed the community. They saw what we were doing to the exterior. They saw the renovations that we were doing, the money that we were injecting into the property, and they chose to stay at a substantially increased renewal rate. Also, we had 8 new leases during this time period as well. So some people just decided not to stay. Not everybody can stay. We had a renewal ratio, meaning the number that we renewed versus how many we tried to have expired leases was over 70%. So that was a pretty good ratio for us. But we still had those that didn't choose to stay, and we had 8 new leases, and those were significantly increased rental rates as well. Comparing the overall rental increases from our new leases and from our renewals, we increased the average rent 26.5%. That's pretty significant. If you look at Houston, because we've got a lot of properties in Houston, we're not seeing 26.5%. Maybe you guys are on some of your properties, but we didn't see that in Houston in some of the properties that we have. So that was a pretty big difference for us, and it's a $6,780 per month increase in income.
Okay, I don't want people to get misunderstood here. We increased it by 25%, which everybody's like, God, these people are crazy. They're going in there. They understood what the market was around them. They went and shopped properties around before we bought it, and they said, okay, well, this is the price of the market. This is the price on a comparison basis. So they knew they had a lot of room to raise rents to market or to an existing level. And you probably didn't even get quite to market yet. So that's what they did. So they knew to some extent they could go up to that. Now, whether you're that aggressive and do, some owners do, some are like, well, that's just too much. I want to let's start with $100 and go with that.
Then you talk to Randa, and she says.
And Randa busts your ass, and you come in there and you're like, yes, okay.
Did you?
Be aggressive. So that's what they did. But don't think that they went in there and just because they beautified the place or whatever, they were able to increase it by 26%. They had their market research done before they purchased the price, and they knew what kind of gap they had to do that with. All right? Again, we teach that, don't we? Yeah, I think we teach that. So cool.
So the other thing that we did is that helped us to be able to raise the rents. We did know what our competition was doing, but we also knew that what we had to offer, we needed to improve. We needed to improve our curb appeal, make this look a much more inviting property, and we did that by doing some exterior and interior renovations. We also revised some of our contracts. Josh talked about how NOI, which is how your property is evaluated, is your income minus your expenses. So we increased our income, but we also wanted to decrease our expenses. And some of the ways that we decreased our expenses was by renegotiating our contracts. We have 4.7 acres, nearly 5 acres. That's a lot of land to have to maintain and mulch and cut the grass and all that sort of thing. So we cut our landscaping budget considerably, as well as we looked into some of the other higher costs, which are marketing costs, and we renegotiated those contracts. Another thing that we did was to increase our income by increasing our bill back to our residents for fixed utilities. So the previous management was not passing on a lot of the cost associated with those utilities back to the residents, at least not to they were significantly undercharging them. So day one, we come in there, we change the pay structure for that, and we started billing back something that was still reasonable for them, but more advantageous. And then our big kicker, this is our big bonus. And once this all comes into play, this is going to be great. But we talked about how that we had a leasing office. A leasing office for a 35-unit property doesn't make a ton of sense because we don't have a leasing person on site. And so what we proposed to do was to take and renovate this leasing office, turn this into a 1-bedroom apartment, and put that on the market. We are in the process of going through all the permitting that is underway for the city, and once that happens, we are going to look at $1,200 per month of income. And as he talked about, at a 6% cap rate, that's another $240,000 of value that is added by just bringing this one unit back onto the market, or back to the market.
And hold on. So go back. Is that included on your 240? Is that in the original projections of how much they made? So that's additional income or additional value that they found after they purchased the property.
Yep.
Probably knew going in, but that wasn't in that current estimate. That was that 3-year estimate we saw. That's an additional $250,000 that they found. Okay, cool. Also, how many ways do we have in the class of increasing NOI? 23? 28. 34?
What?
It's a lot, yeah. Y'all to come, it's a lot of ways we have.
The book says 28.
That's an outdated book. We're constantly adding ways of increasing income, decreasing expenses. Again, we talk as a group, and somebody will come out going, well, I tried this. And we're like, oh, well, crap. Now we'll all try that stuff, add it to the book. So we'll go on from there. Sweet. Awesome.
So how have our lives changed since joining Lifestyles? Well, we're both real estate retired, and we both get to choose what we want to pursue in life. So we actively chose that we wanted to take on active management of one of these projects, not because we needed to, but because we wanted to. She chooses to be an algebra teacher part-time because she wants to, not because we need to. And so that's very freeing, and that freedom that's come with this knowledge and this education has been a blessing to us. So in the short term, we're looking for the next opportunity. We see a lot of good things in Knoxville. We're excited about looking to do another syndication up there when the time is right. So we see that definitely happening. And then we're weeks away from transitioning the oldest son to University of Arkansas. So we're going to be up there doing the move-in, planning trips out there. So he's got a bunch of
I'm
trips.
going to spend a lot of time in Arkansas, just so you know.
We've already got flights booked out to Arkansas a bunch of times for this semester, so it'll be good.
All right, I have a question. So you're already real estate retired,
Yep.
right? You're going to go do additional syndications and what?
We need things to do.
Very good.
We can't, I mean, this is the whole point. Since 2014, I've not had to go to my corporate job, but I wanted to do more things. We've bought properties, we've invested passively, we've done a lot of these things, but we get a lot of satisfaction out of seeing numbers like we have, and seeing projects, and seeing timelines fulfilled, and seeing, milestones being met. So that's why we do this.
Very good. We do advocate that you can retire on real estate and kind of do what you want. We advocate you can retire on real estate and do what you want, right? We're all kind of passively invested. When we talk about passive investing, again, we'll go over that this weekend. It's when I invested with them and gave them money, that additional $2.7 million they raised. That's passive people giving in their money to invest. So how many passives do you have on this deal?
68 others.
68? Whew, that's crazy. And what's the what's the smallest amount one of those guys invested in y'all's? Do you remember?
25,000.
$25,000. So for $25,000, you could be a part of this. You would make the same returns that they make, right, that any other investor make. They have money in the deal as well, but if you invested $25,000, you could get a 64% return on that 25 in 3 years. I'm guessing it might be a little bit better than that. We've already identified another $250,000 on that, so it'll probably be a little bit better than that. But just know what you have, passively invest. You can invest, you have investors probably 100 or 200,000. You can put in whatever you want to in a deal. So very good. Kudos.
I have a question. So is it, if I did 25,000, would I be made whole and then 64%?
Yes.
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 Okay. So the question was, if I put in 25,000, would I make 64% of the 25? No, you get the 25 back, and you make an additional 64% on top of that. I can't do that math. That's too much for me. Okay? Very good. So, awesome. All right, do we have any questions? I think we have time for a couple questions. Oh, wait. Who's on your team? Let's go through the team. Sorry. Let's go on. Who's on your team first?
So we obviously couldn't have done this alone. We had a great team with us. We had mentors Mark Petz, Lee Carroll, Nicole Smith. And then from operations, we also had the lovely Miss Randa Dick over there.
So just to say, we actually had an opportunity for Randa to come out to our property. We had Lee come out to our property. We did we didn't know it was called a summit at the time, but we did a Tennessee summit, East Tennessee summit with some of the guys here in the room, and got feedback from operations even after we started operating. So, I mean, that was ideal for us to be able to have that type of mentorship in our property in Tennessee.
Awesome. Yeah, again, we have groups around the country. We have groups that, obviously here in Houston, even some parts of Houston, that groups get together. They look at each other's property. They give advice. It's really a family affair. And you may not, sometimes it's tough love. Like, why the hell are you doing that? But it's good. It's like, why you want in business? So, yes, questions?
I actually have two questions. Do you guys live here or in Knoxville? And the second one is, do you self-manage or third-party manage?
First question, we live in Houston, and we have a third-party management company that runs the daily operations.
Awesome. Yes.
I probably should know this, but out of the 35 units, how many have you rehabbed so far?
I should probably know this too.
At least 8.
Did we mention they increased rents by like 25%?
So 8 of them.
8. We have 8 new leases, so we had to do some portion of renovation or even just clean it up. But some of them had significant renovations, we did everything from appliances to cabinets, everything. And some of them we were able to just go in and paint and get ready for the new guys.
Keep in mind, again, when they first, I think you mentioned on the renewals, they didn't go in and do anything on the renewals, and 20 of the people renewed, and you increased them by $250, $200?
Yeah, $250, almost $300.
Almost $300 just on the people staying in that unit. They did absolutely nothing to it. So when they're looking at renovating a unit and they're going to go in and do all this work, they're first looking, well, can I increase the rent by more than $250 or $300? Because if I can only increase it another $25, you probably don't want to spend all that money on that rehab. But if I can increase the rent by another $300 on top of that, then it's definitely worth it. So you have to know your market. But what they did originally by going in and seeing kind of where the market is and making sure you can get to that, that's exactly what you need to be doing. So, any other questions? Over here.
Hello. This is just one of the 2 apartments, right? The apartment complex and the exit strategy, please.
So the first question was, is it one of 2? Yes. So we've got a second apartment complex that's actually part of a portfolio, and that one's called Flats at Hutton, and it's 20 units. In terms of the exit strategy, what seems really good to me is the Knoxville County reappraises property values on a 4-year cycle, with the next cycle coming up in 2026. So one of the best things you could possibly do for somebody coming in is have their property taxes defined for them for the first 4 years of their ownership. So for me, if we've done our job and it's looking pretty good, then a sale in early 2026 would make a lot of sense. I think that we'd probably lean toward disposition rather than refinance. So, we still got a lot of things to do and things to accomplish, but that's kind of what we're looking at.
When you marketed this to your partners, what was the original time frame?
So we had called it about a 5 to 7 year hold.
Okay, 5 to 7 years old. And just know that when a lead takes over a deal, they're constantly looking at when they want to refi, or when, if somebody comes in and offers you stupid ass money, you're like, sure, I'll sell it for whatever it is, right? And how much it takes. That's a constant review, but the original plan is 5 to 7 years, and that's kind of what we're looking at right now when we acquire a property. All right, very good. Well, how about a great hand of applause? That was awesome. Thank you guys very much.